Hello, today I'm going to talk about this ETF called CLIX. It is an long short ETF offered by a company called ProShares. Long short strategy is commonly used by hedge funds, and they are long on certain companies where the expectations are these companies are going to perform well in the future, and on the other end they're short on a few companies with the expectation that these companies are not going to perform well, they are not going to survive in future, because they're not adapting, their business is not good, their revenue will fall, their profit margin will go down. So it is very important with this strategy to select your long and short companies properly. Um, it is very difficult for a retail investor to do this sort of research and also to short any particular company. And here we're talking about shorting a bunch of companies, so it is very difficult for retail or individual investors to do this. But then there are like two ways to invest through long short strategies. One is to invest in such mutual funds, and another is to invest in such ETFs. Yeah, they're going to charge some expense ratio. With mutual fund it would be around like 1 to 3%. With ETF it's usually less than 1%. But today we are going to talk about this specific ETF called CLIX. This is one of my favorite during these volatile period pandemic. Uh, so in general, long short ETF or long short strategy reduces exposure to equity market, and that's why the correlation with stock market is lower compared to long only position, and also um, volatility is also lower compared to long only positions. And this is very important because it reduces your drawdown and gives you kind of a balanced investment, right? So let's see what this CLIX ETF is. So it is long online and short store ETF. Long online means e-commerce companies like Amazon or Etsy, Alibaba. So if these companies do well, then this ETF is going to do good. And on the other end, it's short on stores, which means that traditional brick and mortar companies like Best Buy, Macy's, Bed Bath and Beyond. So if these companies don't do well, their revenue goes down, their profit shrinks, then also there is opportunity for investors to earn money here. Now, at, during 2020 so far, 25 retailers have filed bankruptcy so far, and it includes many known names like Neiman Marcus, JCPenney, a few more companies are going to file for bankruptcy by end of the year. And this is not just because of the pandemic. These companies, I think they were not adapting to this new online market, and this pandemic, it just fastened the whole process, it just expedited the process, but otherwise this was just matter of time. So coming back here, this ETF, so consumers behavior has been changing even before pandemic. More and more people were preferring to buy online, and this pandemic has just made the whole process fast. You know, I myself had never purchased grocery online, but then recently I started using Instacart because I don't want to, go to stores and risk of contracting to virus and anything, right? Now, uh, so this is not very popular ETF so far. It has net assets around 186 million, and this is as of 30th June 2020. And net operating expense is 0.65. This is not bad according to me. Usually long short ETFs have slightly higher operating expense than long only ETFs like SPY or any of the Vanguard's long only ETF. Yeah. But then if you see here, it has performed really well. This year was ideal for these ETF. Online went up, stores went down, and these has benefited from both the scenarios. And I would say this ETF was perfectly made for this kind of situation. So year to date, it has gone up 48%, and 1 year is 33%. Pretty good, right? Pretty good. um let's see more about performance here, right? So this is a site called Portfolio Visualizer, and um CLIX is 100%, and then I'm comparing it to Vanguard uh, 500 index. Yeah. So you can see here, initial investment was 10,000, and since inception, so this ETF was started around like end of 2017, and you can see here. Let me use logarithmic scale so that we can see change more accurately, right? So even before pandemic, it has performed well compared to uh, SNPY. And here, this is where it makes real difference, right? So due to pandemic, this goes down, and at this point, we are basically where we started, right? After 2 years, we are basically at 10,000 again. But then here, this just like goes up. This is like crazy. And you can see CAGR is 35% annual growth rate, which is just like amazing and something that unheard of. Sharpe ratio is way better than Vanguard. And as we were talking about this earlier, market correlation is also lower, right? So this is what we want. Like, we want some stocks or ETF in our portfolio where correlation to market is lower. Like, even if market doesn't do well, we want some possibility of generating some return. On the other end, maximum drawdown is minus 15%, which is lower than SNPY index. And also, like, worst year performance was 6% due to, and best year performance 75%. This is amazing. Now here you can see 2018 CLIX performed better overall. Stock market didn't do well in 2018. During end of 2018, overall stock market went down, but then still these CLIX was able to generate some return. 2019 was amazing year, so everything went up. Now here you can see these did not perform better than long only position, because this is like more balanced. So if short companies that we are shorting, they perform well, then we are not going to see that return in our ETF. But on the other end here, it's up, it's generated like 75%. It's great. This portfolio has generated 75%, which is great. Monthly returns. So you can see here, this is the time when pandemic happened, where went down 8%, 12%, but then these has been positive through the year. So you want something like this in your portfolio to keep it more balanced drawdown. Usually, I think the drawdown with this ETF is lower, just not here during this period. But other than that, it's like it's been lower compared to long only position. And um, yeah, all right. So let's come back to holdings here. Like what are the long positions and what are the short positions? Long positions are Amazon, Alibaba, Curate Retail, eBay, Etsy. Like these name doesn't need any introduction here. And these are global companies. This is US, is China. Mercado Libre is was founded in Argentina. Yeah, 5R was founded in Israel. So these are global e-commerce companies, and also are these operates in different domain, and they are like offering everything from clothes to food, different a marketplace to get things done, furniture, everything. On the other end, short companies are these traditional um, companies. um, I mean, definitely, these companies are not going to do well in the future compared to these companies. So the basic condition here is to select long position is must be an online or e-commerce company. Primarily, they should be earning, or primary channel to generate revenue should be online. Market cap at least 500 million. So these are like big companies. And there are also other conditions here. You can read that in more detail. On the other end, short companies are at least 75% revenue comes from store. So that's like most of their revenue comes from in-store operation. And they're the same market cap is also 500 millions. These are big companies, but then they haven't, I think, adapted well to the internet, and they're still having this old school style, just selling their stuff through, in store. And most of these companies also have online channel, but it seems that customers have so far preferred going to their store and buying. So this is a good mix of long and short position. And number of short companies 45, number of long companies 26. And one interesting thing here is short portion is equally weighted. So every company is equally weighted in the short, but long companies weights are different. So I think primarily, if like Amazon and Alibaba and these companies, if these companies do well, then these clicks will do well. And at the same time, if these companies don't do well, then also I think clicks will do well. So yeah, this was just my um, reading of different facts about clicks. And if you want me to do any this kind of like exploration of any other ETFs, just post your comments and we'll go through some of the basic stuff. All right, thanks.